Welcome to part 3 of 5 of our Mr. Fiscal web series. My name is Christine Huang, and I'm going to be talking to you about debt management today. These are our disclosures. They're the same as our first 2 series. Our disclaimers are also the same from our first 2 parts of the series, but again, a reminder, I'm a family medicine doctor, not a financial advisor, so these are my own personal opinions. So some objectives. By the end of this webinar, participants will be able to know how to measure their current debt load, understand how to determine their debt to income ratio, understand the concept of good debt versus bad debt. Participants will also be able to risk stratify their debt load to focus on debt resolution and identify the 2 most common methods of debt repayment. And I'll also briefly touch on some mortgages and student loans, as well as how to find a financial advisor if that's something that you decide that you want. In order to be able to reach your financial goals for the future, you need to know where you're starting from. And that means you need to know how much debt you're dealing with. Your debt load is the total amount of debt your household carries broken down into monthly payments. So what do you include in your debt? Your debt consists of your rent or mortgage, student loans, auto loan or lease payment, credit card debt calculated by the minimum monthly payment, and any other debt you may carry, such as child support, other personal loans, or alimony payments. What don't you include in your debt? So the things you don't want to include in your debt are things like your utilities, so gas, cable, electric, etc., your groceries, gas, money you spend on entertainment expenses like movie tickets, eating out, and insurance premiums like auto insurance or health insurance. Those kinds of expenses belong in your budget. Now to figure out your gross income. Your gross income is your income before taxes or any other deductions. For most of you, this is your salary, as you likely don't have any other sources of income right now, but that could change when you sign your first contract. So what are some other things that are considered income? Any bonuses or tips you receive, including moonlighting, and any additional money that you receive monthly, such as a stipend, alimony, Social Security payments, pension money, or income from investments. How do you know when your balance of debt outweighs your income? So this is where the debt to income ratio comes in. Financial institutions use debt to income ratio when they're looking at applicants for a loan or for extending a line of credit as a general evaluation of a person's likelihood to be able to make their monthly payments, in addition to things like their credit score. What is generally considered a healthy debt to income ratio is less than 36% of your total gross monthly income. So what this means is you take your debt load that you figured out, divide that by your total gross monthly income, that gives you your debt to income ratio. Percentage is just taking that number and multiplying it by 100. So what is a healthy debt load? If you're a graduating resident and want to evaluate a salary offer to determine if it's high enough to maintain that healthy debt to income ratio, you can simply reformat the equation from the previous slide. So this means that for a graduating family medicine resident whose average starting salary is $180,000 with a gross monthly income of $15,000, a healthy debt to income ratio would mean having a total monthly debt of no greater than $5,400. So why do we even care about debt? Susie Orman says that bad debt is sacrificing your future day needs for your present day desires. So we're going to spend some time looking at the concept of bad debt. What is considered good versus bad debt? It's generally considered that the higher the interest the debt carries, the worse that it is. This is one of the reasons that credit cards generally get labeled as bad debt, as they tend to have the highest interest rate with no return on the interest paid. However, this may not be true for all of you. Military members can often get credit cards at a lower interest rate, and if you pay your credit card off each month using those budgeting skills you learned on the first series, credit cards aren't necessarily bad. Student loans also generally get labeled as bad debt. However, bad is relative, as without those loans, you may not be a doctor. They're generally considered bad during the repayment period, as the interest paid on them has no financial return. In addition, once your income is greater than $80,000 a year, the interest paid towards those debts is no longer tax deductible. Auto loans can be tricky, as the money paid in does result in an asset. However, that asset depreciates with time. Real estate can also be tricky, sometimes thought of as good debt, but you can wind up upside down, meaning you owe more money on the house than the property is worth. So bottom line, it's all relative. What is definitely bad is not making your payments each month, which can wind up on you being listed as defaulted on your loans. This seriously impacts your credit and future finances, so always pay your minimum payments on all debt each month. Now that you know what your debt is, let's talk about some debt resolution. The two most common methods of debt repayment are debt stacking and debt snowballing. The first method is called the debt snowball method and involves prioritizing your repayments by loan balance. The goal is to pay the minimum on all your debts, but prioritize all of your extra repayment into the loan with the lowest balance. When that loan is paid off, you then put the previous monthly payment plus the extra into the next smallest loan. When determining which debt to pay first, you do not take interest into consideration at all, except if your two lowest balance loans have the same balance, then you pay off the loan with the higher interest rate first. So in this example, if your smallest loan has a monthly payment of $250, but you manage to put $350 into it each month, when that debt is paid off, you then put $350 towards your next lowest balance debt, in addition to the minimum monthly payment. The second method is called debt stacking. Debt stacking refers to debt repayment by interest rate. So this means separating out all of your debt to arrange it by interest rate from highest to lowest. Your highest priority debt is going to be that with an interest rate of greater than 7%. This is the debt you should attack aggressively before putting any extra money towards investments or retirement. Debt in the 4 to 6% range is in the gray zone. It's not low enough to let it ride, but not high enough to be the biggest priority. This is when you need to look at your overall financial picture and financial goals to determine your priorities. Your lowest priority debt is going to be the debt within the 0 to 3% range. With debt in this category, you're usually accruing so little in the way of interest that you'd generally be better served financially by doing something else with your money rather than paying more than your minimum monthly payment. So in this example, you want to pay the minimum on all of your debt, but put extra towards the debt with the highest interest rate. Similar to the debt snowball method, when you've paid off the highest interest debt, put that payment plus that little extra towards your next highest interest loan, and so on. Snowball versus stacking. We've talked about both methods. For the snowball method, some of the pros are you can feel more rewarded as you eliminate one debt after another. Some of the cons, you will eventually be paying more over time because higher balance debt tends to accrue more interest. For the stacking method, pro, compared to the snowball method, you will pay less over time by saving the most money in your interest payments. As it's essentially the exact opposite of the snowball. It also may take you the longest to pay off that debt, especially for high balance debt such as student loans and mortgages. So which method is the best? Financial advisors would likely say that the debt stacking method, as you will pay the least amount of money over time. Financial researchers would say that the debt snowball method is better, as evidence supports that people are more likely to continue budgeting and paying consistently towards debt when they can see the short-term payoff. However, in the end, you have to determine which method works best for you and where financial priorities lie. So what are some other methods of repayment? There are some other methods of debt repayment or debt delay that you may have heard of or thought about. First, a word of caution. Depending on your financial situation, some of these techniques may make sense for you. However, many of them delay debt rather than lead to debt resolution and have serious financial implications long-term, both on your credit score and your overall financial health. If you are thinking of using any of these techniques, please discuss your situation with a financial advisor first. So some of these methods, renegotiating with your creditors. This can be very useful if you can't meet your monthly minimum payment. Your primary goal is to avoid being listed as defaulted on your payment. So the goal is to come up to a solution with your creditor to avoid being listed as defaulted, because that can impact your credit score. opening a new credit card and transferring the balance to take advantage of a 0% APR promotion. This tends to only delay the debt, and that 0% APR is a temporary promotion that then generally results in a much higher interest rate later on. Also negatively impact your credit score, further complicating your financial wellness depending on how many credit cards you already have open. Okay, card. What if I borrow against my 401k or my house? So you can do that, but a lot of these come with heavy penalties. Withdrawing money from your 401k before you reach retirement age has penalties to it. So again, discussing this with a financial advisor first. And then file for bankruptcy. This is really a last resort kind of option, has serious financial implications for the rest of your life, and you need to discuss with a financial advisor and a lawyer prior to proceeding. Now that we've talked about financial advisors, how do you find one? How do you know that the financial advisor that you found is a good one? So let me introduce you to the concept of a fiduciary. Fiduciary advisors work in the best interest of their client. They receive compensation solely from their clients in a fee-based manner and not by commission on a product or a service that they recommend. If they have any conflicts of interest, they must disclose that conflict as it arises. So how do you find a fiduciary? The National Association of Personal Financial Advisors has a website to help you locate a financial advisor by you, and their members have to act as a true fiduciary for their clients. Another option is you can see if the individual is a registered investment advisor. This means they've filed paperwork with the U.S. Department of Securities and Exchange Commission. Word of warning, however, an individual or a financial firm can be duly registered, meaning sometimes they may act as a fiduciary and sometimes they may be working on commission. So you want to make sure you get that information up front. The option is the broker check from the Financial Industry Regulatory Authority, which will tell you records on your potential financial advisor with the Certified Financial Planner Board. Much as we have a medical board that we have CME and have to answer to, the Certified Financial Planner Board is that for fiduciary advisor. Still concerned? Ask the financial advisor to sign a fiduciary oath with you as their client. The National Association of Personal Financial Advisors and the Committee for Fiduciary Standard both have oaths that can be downloaded off their website. If the financial advisor won't sign, move on. Switch gears away from debt resolution to talk about mortgages. If you haven't already bought property, many of you will be in the next few years. I'm going to focus on primary residences, which is the fancy way that banks talk about the house that you live in. When you're looking at buying property, you want to determine what you can reasonably afford. A good rule of thumb is 2 to 3 times your annual gross income as your budget. This lets you maximize the property you're getting without having a substantial portion of your income going to your mortgage each month. For a physician making $180,000 a year, this means looking at a property that is no more than $540,000. When most people think about buying a house, they think that they have to have a 20% down payment. And if you don't, then you aren't ready to buy a house. This isn't true in every situation, and especially not for physicians. A 20% down payment lets you avoid paying private mortgage insurance, or PMI, which is a monthly expense to the bank to protect them against a defaulted loan. The money paid to the bank for mortgage insurance does not go towards your principal or your interest, and it's money that's an unnecessary wasted cost each month. You don't have 20% down, you don't want to pay a PMI, and you want to buy a house. What are your options? This is where physician loans can come in. Banks looked at defaulted mortgages by profession, and what they learned is that physicians typically pay their mortgages, and physician loans were born. This generally allows you to put 0 to 10% down as a down payment and avoid mortgage insurance. The downside is that the interest rate tends to be slightly higher than a traditional mortgage, though generally by less than 1%. The benefit to physician loans is that interest paid towards a mortgage is usually tax deductible, while interest paid towards your student loans may not be, as we talked about earlier. In addition, your interest rate on a physician mortgage may be less than the interest rate on your student loans, so putting that down payment towards paying down higher interest student loan debt may be a better financial choice. Details and specific programs vary by state, and interest rates are constantly changing, so you'll need to look at your options, your overall debt, and crunch some numbers to figure out what's best for you when you're ready. Bank of America has a partnership with the American Academy of Family Physicians for their members, which is good across all states. And lastly, for some of our military residents out there, you may also have the option of a VA loan. It's another way to secure a mortgage with no down payment and no PMI. It does come with some associated funding fees to the VA. However, you may be able to get the seller to pay this cost. The dreaded student loans. This is going to be really brief, as it could be a whole topic on its own. When it comes to loan repayment for student loans, there are a lot of options. So let's start with the Department of Education. There are different loan repayment programs, including standard repayment, pay-as-you-earn, revised pay-as-you-earn, income-based repayment, and income-driven repayment. Big thing is on studentloans.gov, there are calculators available to help you determine what your monthly payment would be using the different methods. If you haven't looked into these options, look into them ASAP, as you do not want to be on standard repayment as a resident, and you want to avoid deferment if at all possible. Finish training, several other options exist for you. You may be able to negotiate some loan repayment into your contract with your employer, either as a one-time bonus or a yearly bonus. If you're not able to negotiate any loan forgiveness into your contract and are not trying for public service loan forgiveness, consolidating your debts through a private bank may lower your interest rate. There are usually certain debt to income requirements which may not make this an option while you're in residency. However, the American Academy of Family Physicians has a partnership with SoFi, one of several institutions that provides this service, which is available to its members. Brief mention about public service loan forgiveness. Information on this slide is only good as of September 6, 2017, when I made it, and there may be many or no changes to this program in the coming years. What we know right now is that only certain loans qualify for this program. Those are the subsidized and unsubsidized direct loans, Perkins loans, PLUS loans, including Grad PLUS loans, health education assistance loans, and federal nursing loans. Also, in order to qualify, all of your loans need to be serviced through Fed Loan Servicing, and you have to make 120 qualifying payments, which do not have to be consecutive. You have to work for a qualifying organization, which is a government agency or a nonprofit. If you meet all of these requirements, any student loan balance being serviced by Fed Loan Servicing after 120 qualifying payments would be forgiven. October 2017 will be the first application of this program, as it started in October of 2007. Some things to be aware of about the public service loan forgiveness is that the Department of Education reviews your application when you have reached 120 qualifying payments, not before. Fed Loan Servicing is your loan servicer, but they don't make the decision if you qualify, and their certification letter doesn't guarantee that you're eligible. The Public Service Loan Forgiveness Program is projected to cost the federal government $24 billion, and the current budget proposal includes suggestions for eliminating or severely restricting who qualifies and may have loan forgiveness limits. Current participants may still be eligible if the program is eliminated. It's a good option, it's something to be aware of, but also to be aware of the limitations. For the references that I used to put this presentation together, there is a list of links that I referred to in my series, and these links are also available in the information section posted beneath this video. I acknowledge all of the members of the Mr. Fiscal Collaborative that went into making this web series. And for any questions on this presentation, my email address is at the bottom.